How does bond issuer default risk affect your investment plan? Have you ever wondered how the risk of a bond issuer defaulting can impact your investment strategy? Let's break it down in a straightforward way. Bond issuer default risk refers to the possibility that the entity issuing the bond, whether a corporation or government, may fail to make the necessary interest payments or repay the principal amount when the bond matures. This risk is a key factor that can directly influence both the safety and expected returns of your bond investments. When you invest in bonds, you are essentially lending money to the issuer in exchange for regular interest payments and the return of your principal at the end of the bond term. If the issuer cannot meet these obligations, you could face a partial or total loss of your investment. This is where understanding default risk becomes essential. Bonds with higher default risk typically offer higher interest rates. This is a way to attract investors who are willing to take on more risk for the potential of greater returns. On the other hand, bonds with lower default risk, like those from financially stable governments or strong corporations, usually provide lower yields but come with a greater sense of security. For adults planning their investments, it is crucial to balance income needs with risk tolerance. Including a mix of bonds with different levels of default risk can help diversify your portfolio. However, if you invest too heavily in high-risk bonds, you may jeopardize your capital and cash flow stability. To assess default risk before investing, consider the issuer's financial health, credit ratings, and current market conditions. Credit ratings are provided by agencies that evaluate the likelihood of default. A higher rating indicates a lower risk, while a lower rating suggests a higher risk. Default risk also plays a significant role in how your bond investments align with your broader financial goals. If you're relying on bond income for living expenses, focusing on bonds with low default risk is wise to ensure you receive steady payments. Conversely, if you are looking for higher returns and can accept some risk, you might opt for bonds with moderate default risk that offer better yields. In summary, bond issuer default risk is a vital consideration in your investment plan. It affects the safety, income reliability, and potential returns of your bond investments. By carefully evaluating and selecting bonds based on their default risk, you can align your bond holdings with your financial objectives and risk tolerance.